All right, get ready. We're taking a deep dive into Realty Income today, a company that's, known for paying out dividends pretty consistently.
Yeah, they've really embraced that image too. They call themselves the Monthly Dividend Company. And, they've got 30 years of dividend increases is not something you see every day.
That's a pretty amazing track record.
Right.
But before we get lost in the dividend excitement, I think it's important to, understand the business itself. What's Realty Income actually doing to generate that kind of reliable income?
So at its core, Realty Income is a REIT, a real estate investment trust. They own a huge portfolio, over 15,450 commercial properties as of today. We're talking retail, restaurants, industrial facilities. They even own a casino,
Wow, a casino.
Yeah.
I mean, I get the retail and restaurants, but
Yeah.
a casino, that's interesting. And all of these properties are leased out.
Oh, yeah, to single tenants on long-term contracts. That's a key part of their model.
So they're like a giant landlord collecting rent from all these different businesses.
Mm-hmm.
And those long-term leases provide that steady income.
Yeah, it's all about that predictable cash flow, which is what lets them pay out those consistent dividends.
That makes sense. So in our deep dive today, what are we trying to figure out about Realty Income?
The big question is this company a smart investment? We're going to look at their financials, see how they're doing, break down their strategy, and also look at how they stack up against the competition.
Sounds like a solid plan. All right, so let's start with the numbers. What kind of financial picture are we looking at here?
Well, you can't talk about Realty Income without acknowledging their size. They're bringing in about $4.93 billion in annualized contractual rent. That's the money they're expecting to get from their tenants every year,
Yeah.
And their whole portfolio is valued somewhere around $83 billion.
Those are some serious numbers. But as we all know, a big portfolio doesn't automatically mean a healthy business. So how's their cash flow? Are they actually making enough to cover everything, and keep those dividends flowing?
That's the key question. And yeah, their cash flow looks really good. In just the first 9 months of 2024, they had over $2.6 billion in operating cash flow.
That's reassuring, to say the least. But, I got to ask about debt. A company with this many properties, they've got to have a lot of borrowing, right?
You're right. They definitely do have debt. But they're very smart about how they manage it. They use a mix of different funding sources like stock offerings, bonds, even term loans, and credit facilities.
So it's not all coming from one place, they're spreading it out.
Right, exactly. It helps them manage risk. And they also lean towards fixed rate debt, so they're not as vulnerable to interest rate hikes. Plus, they use hedging strategies to, add another layer of protection against interest rate risk.
So they're kind of planning ahead for those potential financial storms, which I always appreciate. It sounds like they're thinking about the long term. Now, with a company this large, they can't just sit still. How are they growing, expanding their portfolio and all that?
Acquisitions, they're big on acquisitions. They're constantly looking for new properties to buy up. Just in the third quarter of 2024 alone, they spent over $740 million on acquisitions.
Wow, that's a pretty impressive shopping spree. What kind of properties are they buying, though? Are they still mostly sticking to retail, or are they branching out?
They're definitely exploring some new areas. Actually, one of their recent acquisitions was a joint venture to get into data centers.
Data centers. That's a whole different world than their usual retail spaces. Why the shift?
Well, data centers are in high demand right now. With cloud computing and all that, it's a booming market.
Makes sense. It seems like they're keeping an eye on those emerging trends. But I'm guessing they're not just buying everything in sight. They must be selling off some properties too, right?
Oh, absolutely. They're always evaluating their portfolio and deciding what to keep, what to buy, and what to sell. In fact, in that same quarter we were talking about, they sold off about $250 million worth of properties.
So it's a balancing act, right? Acquiring new stuff while also selling off others to keep things well balanced. It's like managing a giant real estate puzzle. But with all this buying and selling going on, is their overall performance actually improving?
One of the best ways to measure a REIT's performance is to look at their FFO, funds from operations. It basically tells you how much cash they're generating from their operations. And Realty Income's FFO has jumped a crazy 21.9% this year, reaching almost $2.6 billion.
21.9%. That's not just a jump. That's like a rocket launch.
Yeah.
So I guess that answers my question about whether or not this strategy is working.
Yeah, it seems to be paying off.
And speaking of paying off, what about those dividends we talked about at the beginning?
Right. They just paid out 0.2635 per share.
Not bad at all.
And with those strong financials and FFO growth, it looks like they're in a good spot to keep those dividends coming.
So to recap, they're financially solid, managing their debt well, they're growing through acquisitions, selling off some assets, and their performance is up. But what's the big picture here? What's driving all of this?
Yeah.
What's their strategy?
That's the million-dollar question. And that's exactly what we're going to dive into next.
Okay, before we jump into that,
Yeah.
anything about these financials that stands out to you, good or bad?
What really impresses me is that they've managed to grow so much while still keeping a really strong financial foundation. Their debt management is smart, cash flow is strong, and their profitability is climbing.
So it's not just growth for the sake of growth, it's sustainable, which is what matters.
Exactly.
All right, well, I'm definitely ready to hear more about their strategic approach. Let's get into it.
All right, so let's look at what makes Realty Income tick strategy-wise. One of the biggest things they've got going for them is their size. We're talking over 15,000 properties. That gives them a lot of leverage.
Yeah, it's like they say, bigger's better, right? But I'm curious, how does that size actually translate into an advantage in the real estate world?
Well, think about it. If you're a business, you want to sell a property and lease it back, you're going to get a much smoother deal with a company like Realty Income. They have the resources to close deals quickly, efficiently.
Okay, so they can move faster and probably offer better terms too, I imagine.
Right, exactly.
And we saw that with their move into Europe, right? Expanding into a whole new continent.
Yeah.
It takes a company with deep pockets to even attempt something like that.
Absolutely. And that move also highlights another key part of their strategy. They focus on what they call mission-critical properties.
Mission critical.
Yeah, basically properties that are essential to the tenant's business, like drugstores, grocery stores, convenience stores, places that people rely on no matter what the economy is doing.
So it's not just about the type of property. It's about how important that property is to the tenant's survival. A drugstore needs a physical location. They can't just go online. So even if there's a recession, Realty Income's tenants are more likely to keep paying rent.
Right. It reduces their risk of vacancies, makes their income more stable.
It's a smart way to play it safe. Speaking of playing it safe, you mentioned they bought a casino. That seems kind of risky, doesn't it?
Well, you got to look at it in context. Casinos generate a lot of revenue, and they rely heavily on their physical location. They're not going anywhere. Plus, this particular casino, Encore Boston Harbor, it's a luxury destination. Their clientele is probably less affected by economic downturns.
I see. So it's a calculated risk, but still within their overall strategy.
Right. They're still focused on owning properties that are vital to their tenants' success.
Okay, that makes sense. So they've got this focus on mission-critical properties. But what about their investment process itself? Do they just buy anything that looks good? Or is there a more, methodical approach?
Oh, they're very disciplined about their investments. They have a data-driven approach. They're not just going on gut feeling.
So they're crunching the numbers, doing their research before they make a move.
Absolutely. They look at things like the long-term internal rate of return, IRR.
IRR, that's one of those financial terms that can be a little confusing.
Yeah, think of it like this. IRR is basically the annual rate of return an investment is expected to generate. It takes into account the time value of money, so money earned today is worth more than money earned later. Realty Income uses IRR to compare different investment opportunities and choose the ones that are likely to give them the best returns.
So they're always looking to maximize their profits over the long term.
That's the goal.
And you mentioned something else earlier, a weighted average cost of capital hurdle rate. What was that all about?
Right. That's another important part of their process. Basically, they set a minimum return they need to achieve on any investment.
So like a minimum passing grade.
Exactly. It's a way to make sure they're not taking on projects that are too risky or that won't generate enough profit to justify the cost of capital.
Makes sense. It's like a safety net to protect them from bad deals.
Right. And it's not just about buying properties either. They're really good at managing their portfolio once they own it. They have this incredible track record of getting higher rents when they release properties. Their historical recapture rate is over 102%, which means they're actually getting more rent on renewals.
So they're not afraid to negotiate, even with their existing tenants.
They're always looking for ways to maximize the value of their portfolio.
That's impressive. All right, so we've talked about their focus on those mission-critical properties, their data-driven investment process, and their talent for squeezing more value out of their portfolio. It's a pretty solid strategy. But even with the best strategy, you can't ignore the competition, right? Who else is out there fighting for a piece of the real estate pie?
That's a great question, and that's exactly what we're going to dig into next.
Yeah, bring on the competition. All right, let's talk competition. Realty Income's doing well, but they're not the only ones in the game. Who else is out there trying to grab a piece of that real estate pie?
Well, it's a crowded market for sure, especially in the net lease sector where Realty Income focuses. But it's also very fragmented.
Fragmented meaning?
It means there's not one giant company controlling everything. Lots of players, big and small, but no one's dominating the whole market.
So even though Realty Income's huge, there's still room for them to grow.
Exactly. There's plenty of space for them to expand.
So who are some of the other players? Who are they up against?
There's National Retail Properties, WP Carey, Store Capital, to name a few. They're all in that same space, single-tenant net lease properties.
Okay, so they've got company. But what makes Realty Income different? What sets them apart from these other companies?
Well, their size is definitely a big advantage, like we talked about before. They have the resources to handle those big, complicated deals. Remember that Encore Boston Harbor casino acquisition?
Yeah, that was a big one.
Not many companies could pull that off. And their focus on those mission-critical properties, that sets them apart too. They're not just chasing the latest fads. They're building a portfolio of properties that are, essential to their tenants.
So they're thinking long-term, focusing on stability.
Right, exactly.
But even with all that going for them, there's got to be some downsides, right?
Yeah.
What are some of the risks investors should be thinking about?
Well, like any REIT, they're sensitive to interest rate changes. If rates go up, their borrowing costs go up, which can cut into profits.
Yeah, that makes sense.
They use hedging strategies to help manage that risk, but it's still something to consider.
And what about their tenants?
Right. They are reliant on certain clients, especially their top 20 tenants. Those tenants make up a pretty significant portion of their income.
So if one of those big tenants goes under, it could really hurt Realty Income.
It could definitely have an impact.
And how would they handle a recession? Everyone seems to be worried about that these days.
Well, a recession would definitely bring some challenges. Businesses tend to struggle during those times, which could lead to more tenant bankruptcies. And it might become harder to collect rent.
So even those mission-critical properties aren't completely immune to economic pressures.
Unfortunately, no.
All right, so some risks to consider. But overall, what's your outlook for Realty Income? Do you think they'll continue to do well in the future?
Well, they've released some guidance for the rest of 2024, and it's mostly positive. They're projecting increased investment volume, so they're planning to buy more properties. And they expect FFO per share to keep growing, which is a good sign for profitability.
Okay, so they're optimistic.
Yeah, but they did mention some potential challenges. They talked about the impact of reserve reversals.
Reserve reversals.
Basically, companies set aside money in reserves to cover potential expenses, but sometimes those reserves are higher than needed, and they can reverse them, which means they add that money back into their earnings.
So it's like finding some extra cash you forgot about.
Yeah, kind of.
Yeah.
But the problem is those reversals can sometimes make a company's performance look better than it really is.
So it's not always a true reflection of how they're doing.
Right. Realty Income has benefited from some reserve reversals, which has helped their earnings. But as those reversals wind down, it could affect their same-store rent growth.
Which is a key metric for their business, right?
Exactly.
So something to keep an eye on. It doesn't necessarily mean they're in trouble, but it's a reminder that things can change,
Absolutely.
Well, we've covered a lot today, from their financials to their strategy to the competition. But at the end of the day, the decision to invest or not is up to each individual.
That's right.
We've given you the information and the analysis, but you have to decide if Realty Income fits your goals and your risk tolerance.
Investing is all about learning and making informed decisions. And hopefully this deep dive has given you the knowledge you need to do that.
Well said. And remember, the real estate world is always changing, so keep learning and never be afraid to ask questions.
That's great advice.
Well, thanks for joining me on this deep dive.
It was my pleasure.
Until next time.